Let me tell you something that's going to bother you. And I'm telling you because I'd rather it bother you now, while you can still do something about it, than in 10 years when it's too late. There are people in this country who work 20, maybe 22 years, and they're bringing home more spendable retirement income every single month than their neighbors who worked 35 years. More money in their pocket, less stress about taxes, lower Medicare premiums, a bigger Social Security check, and they worked 13 fewer years. That doesn't seem fair, does it? It's not supposed to make sense. You'd think that more years of work, more years of saving, more years of paying into the system would automatically mean a bigger, more comfortable retirement. That's what we were all taught. Work hard, save diligently, and you'll be taken care of. But the retirement system in America doesn't work that way. It doesn't reward the person who worked the most years. It rewards the person who understood the rules. And today, I'm going to show you exactly how that happens, where long career workers lose ground, and what you can do about it, even if you're already retired. Let's start with how Social Security actually calculates your benefit, because this is where the first surprise lives. Social Security looks at your highest 35 years of inflation-adjusted earnings. It averages those out into something called your average indexed monthly earnings, or AIM. If you worked fewer than 35 years, zeros get plugged in for the missing years, which drags the average down. So far, that sounds like working more years is better. And it is, up to a point. But here's what most people miss. The benefit formula is heavily progressive. The first $1,974 of your AIM, using the 2025 Ben points, is replaced at 90 cents on the dollar. The next chunk, up to about $7,078, is replaced at only 32 cents on the dollar. And anything above that is replaced at just 15 cents. Think about what that means. A worker earning $40,000 a year for 20 years gets a much higher return per dollar earned than a worker earning $120,000 for 35 years. The system is designed to replace a larger share of income for lower and middle earners. It's progressive on purpose. So after about 25 to 30 years of solid earnings, each additional year of work adds very little to your Social Security benefit. You're past the high replacement Ben points. You're working for 15 cents on the dollar at the margin. That extra year of grinding doesn't move the needle nearly as much as you'd think. Now, here's where it gets worse. The claiming age trap. Workers who push through 30 or 35 years in physically demanding or mentally draining jobs are often exhausted by their early 60s. They've earned it. They're done. And the moment they stop working, most of them walk straight into the Social Security office and claim at 62. Studies consistently show that blue-collar workers and people in physically demanding careers have significantly higher early claiming rates. Claiming at 62 instead of waiting until full retirement age at 67 permanently reduces your monthly benefit by about 30%. Claiming at 62 instead of waiting until 70 cuts your benefit by roughly 43% compared to the maximum. Let me put real numbers on this. A worker entitled to $2,800 per month at 67, who claims at 62, gets approximately $1,960 per month. For life. No do-overs, no adjustments. That's the check forever. Now picture someone else. She worked 22 years. Her benefit at 67 would have been about $2,000 per month, less than the first person's. But she delays claiming until 70, with delayed retirement credits adding 8% per year past full retirement age. Her check at 70 comes out to approximately $2,480 per month. Plus, every future cost of living adjustment compounds on that larger base. The person who worked 13 fewer years ends up with a permanently higher monthly check. Not because she earned more. Not because she got lucky. Because she understood that the 8% per year delayed retirement credit is a guaranteed, inflation-adjusted, government-backed return that's nearly impossible to match anywhere else. The 35-year worker, who claimed early out of fatigue just gave up over $500 a month for the rest of his life. That's more than $6,000 a year. Over 20 years, that's $120,000 in lost income. And that's before you account for the compounding effect of higher cost of living adjustments on the larger benefit. Now, let's talk about the tax bracket collision, because this is where long careers create a problem that almost nobody sees coming. A worker who stays employed full-time into their mid-60s often has their highest earning years stacking right on top of Social Security and early required minimum distributions. A 66-year-old still earning $80,000 in salary, who also starts Social Security at 66 and has a small RMD from a rollover IRA, can easily find themselves in the 22 or 24% federal bracket with up to 85% of their Social Security taxable. They may be paying more in total tax than they ever did during their peak earning years. Meanwhile, someone who stopped full-time work at 58 and lived off taxable savings for a few years has something incredibly valuable: low-income years. And those low-income years open a window that the tax code practically begs you to use. That window is the Roth conversion opportunity. A Roth conversion moves money from a traditional IRA or 401k into a Roth account. You pay income tax on the converted amount now, but the money grows tax-free and comes out tax-free forever. No required minimum distributions. No impact on your provisional income calculation. No ARMA surcharges from Medicare. The ideal time to do Roth conversions is when your taxable income is temporarily low. And for most people, the only way to get low-income years is to stop working before Social Security and RMDs begin. Someone who retires at 60 and has 7 to 13 years before RMDs start at 73 can systematically convert chunks of their traditional IRA into a Roth, filling up the 10 and 12% brackets each year. Over a decade, they might move $300,000 to $500,000 into a Roth at tax rates far below what they would have paid if that same money came out as forced RMDs in their 70s and 80s. A worker who stays employed full-time until 67 or 70 has almost no low bracket years. Their salary fills those brackets completely. When RMDs start on top of Social Security, they're pushed into 22, 24, or even 32% territory with no room to convert at all. The math is stark. Converting $50,000 per year at 12% costs $6,000 in tax. Taking that same $50,000 as a forced RMD at 24% costs $12,000. And the RMD also makes more Social Security taxable and can trigger Medicare ARMA surcharges. The person who stopped working earlier and used the gap years to restructure pays dramatically less in lifetime taxes than the person who kept grinding and never had a low-income year to take advantage of. This leads directly to the withdrawal order problem, and this is where years of diligent saving can actually backfire. Most long career workers save faithfully into tax-deferred accounts for 30 or 35 years. 401ks, traditional IRAs. By retirement, the vast majority of their wealth sits in accounts where every single dollar withdrawn is taxed as ordinary income. They have no flexibility. Every dollar they spend triggers a tax event. A retiree with $1.2 million in a traditional IRA and almost nothing in Roth or taxable accounts is stuck. When RMDs start in their 70s, they might be forced to take $50,000 to $80,000 a year in taxable income, whether they need it or not. That pushes their Social Security into the 85% taxable zone. That triggers IRMA surcharges on Medicare. And there's nothing they can do about it because every dollar has to come from the same tax-deferred bucket. Compare that to someone who worked fewer years but diversified across 3 buckets. A taxable brokerage account where long-term capital gains can be taxed at 0% in lower brackets. a tax-deferred IRA for controlled withdrawals, and a Roth for tax-free income and emergencies. That three-bucket red array can design each year's income like an architect. Pull from the taxable account to harvest 0% capital gains. Take just enough from the IRA to fill a low bracket. Use the Roth for anything above that without adding a dime to their adjusted gross income. The long career worker with everything in one bucket has no such luxury. Now let me explain the two tax traps that compound all of this: the Social Security tax torpedo and Medicare IRMA. Up to 85% of your Social Security benefits can become taxable at the federal level once your provisional income exceeds $44,000 for married couples filing jointly. Provisional income is your adjusted gross income plus tax-exempt interest plus half of your Social Security. Those thresholds have not been adjusted for inflation since 1993. That means they catch more retirees every single year. Here's how it punishes a long career worker. A $3,000 monthly Social Security benefit, which is $36,000 a year, combined with $30,000 in RMDs and $10,000 in pension income, creates a provisional income of roughly $58,000, well above the threshold. Up to $30,600 of that Social Security becomes taxable income on top of everything else. Tax professionals call this the tax torpedo. In that zone, each additional dollar of ordinary income can effectively create $1.85 in taxable income. The dollar itself, plus the Social Security it drags into taxation. The hidden marginal tax rate in that zone is far higher than the bracket alone suggests. Most people never see it until it's already hitting them. The strategic red array, who converted much of their IRA to Roth during low-income years and uses Roth withdrawals, which don't count in provisional income, can stay below these thresholds entirely. Their Social Security may be taxed at 0 or 50% instead of 85%. That difference alone can save thousands of dollars every single year for the rest of their retirement. And then there's Medicare IRMA. If your modified adjusted gross income from 2 years ago exceeds $106,000 for single filers or $212,000 for joint filers, your Medicare Part B and Part D premiums go up. Those surcharges can add $200 to $500 or more per month per person, and they're based on income from 2 years prior, which means a big final working year or a year with 2 RMDs can cause higher premiums that hit you 24 months later when you've forgotten about the income event that caused them. The only appeals process is Form SSA 44, which requires a qualifying life-changing event like retirement, the death of a spouse, or a divorce. Simply having a one-time high-income year from a big RMD or a Roth conversion does not qualify for an exception. Most people only find out about IRMA when they open a letter from Social Security saying their premiums are going up. By then, the income event that caused it happened 2 years ago, and there's nothing to be done about it. The strategic retiree who stopped working at 60 and kept income low through careful Roth conversions and taxable account spending may never trigger IRMA at all. Over a 20-year retirement, that can save tens of thousands of dollars in Medicare surcharges alone, compared to the long career worker who kept earning through their mid-60s and never had a low-income year to cushion the transition. Take a breath here. I know this is a lot, but stay with me, because the next part is where everything clicks. I'm going to show you 2 real people, side by side, with real numbers, so you can see exactly how this plays out in actual life. The strategic retiree who stopped working at 60 and kept income low through careful Roth conversions and taxable account spending may never trigger IRMA at all. Over a 20-year retirement, that can save tens of thousands of dollars in Medicare surcharges alone. Let me bring all of this together with 2 people. Call them Gary and Maria. Gary worked 35 years as an engineer, earning $95,000 in his final years. He was tired. He claimed Social Security at 63. He never did a Roth conversion. He has $900,000 in a traditional 401k and started RMDs at 73. At 75, Gary's monthly picture looks like this. Social Security of $2,100, reduced for early claiming. RMD of roughly $3,200. Total gross income about $5,300 per month. Sounds solid. But after federal tax in the 22% bracket, state tax, IRMA surcharges, and 85% Social Security taxation, his spendable income is closer to $3,900 per month. Maria worked 22 years as a teacher and part-time consultant, earning $55,000 in her best years. She retired at 58. She did systematic Roth conversions from 59 to 69, filling the 12% bracket each year. She delayed Social Security until 70. At 75, she has $400,000 in a Roth, $200,000 in a taxable brokerage, and about $150,000 remaining in a traditional IRA. Maria's monthly picture at 75. Social Security of $2,350, boosted by delayed credits. A small RMD of about $550. A Roth withdrawal of $1,500. Completely tax-free. Doesn't count toward provisional income. Total gross income about $4,400. After tax at 12% on just the RMD, no IRMA, and only 50% Social Security taxation. Her spendable income is about $4,050 per month. Maria worked 13 fewer years, earned less per year, saved less total, and she ends up with more money in her pocket every single month than Gary. Not because she was smarter, not because she got an inheritance, because she understood the rules and Gary just worked harder. That's the uncomfortable truth. You cannot outwork bad strategy, but you can always start making better decisions. So here's what you can do about this, starting this week. Step 1. Log into the Social Security Administration website and print your benefit estimates at 62, full retirement age, and 70. Don't look at the percentages. Look at the actual dollar amount you'd receive per month for the rest of your life under each scenario. Write those numbers down. Step 2. Add up the total balance in all your tax-deferred accounts. Traditional IRAs, 401ks, 403bs, TSPS. Then go to any free RMD calculator online and project what the IRS will force you to take at 73, 78, 83. Imagine that number stacking on top of your Social Security and any pension income. That's your future tax picture if nothing changes. Step 3. If you're between 55 and 65 and still working, ask yourself the hardest question. Am I working these extra years because I truly need the money, or because I'm afraid to stop? Run the numbers on what your income plan would look like if you stop full-time work next year. Bridge the gap with savings and use those low-income years for Roth conversions before RMDs begin. The answer might surprise you. Step 4. If almost everything you own is in tax-deferred accounts and you have little or nothing in Roth or taxable, that is the single biggest structural problem to fix before RMDs start. Even small annual Roth conversions of $20,000 to $50,000 in the 12% bracket over 5 to 10 years can dramatically change your tax situation in your 70s and 80s. Step 5. Sit down with a fee-only fiduciary financial planner, not a commission-based advisor, and ask them to model 3 scenarios. Retire now, retire in 2 years, retire in 5 years. With coordinated Social Security timing, Roth conversion schedules, and withdrawal order strategies. The difference between the best and worst scenario is often $200,000 to $500,000 in lifetime spendable income. That's not a rounding error. That's a second retirement. Now, before I go, let me say something important. This video is not meant to make anyone feel bad about working 30 or 40 years. If that's your story, you should be proud of it. That dedication built a life, raised a family, and created the savings that make all of this planning possible in the first place. You cannot convert money to a Roth if you never saved any money. You cannot delay Social Security if you didn't have the discipline to build something to live on in the meantime. The foundation matters, but the foundation is not the whole building. The people who get the most out of retirement are the ones who take that foundation and build something intentional on top of it. They don't just save. They think about which accounts to save into. They don't just retire. They think about when to retire and how that timing affects every other piece of the puzzle. They don't just claim Social Security. They think about what happens to their taxes, their Medicare premiums, and their Roth conversion window, depending on when they claim. If you know someone who worked a long career and is now frustrated that their retirement income doesn't seem to match their effort, share this video with them. Not to make them feel bad, but to help them see that there are still moves they can make. Even if you're already 73 and taking RMDs, you can still use QCDs to lower your taxable income. You can still review your withdrawal order. You can still check whether you're paying IRMA surcharges that a simple income adjustment could eliminate. It is never too late to make a smarter decision. Let me leave you with this. The retirement system in America was never designed to reward hard work alone. It was designed around tax rules, benefit formulas, and income thresholds that reward the people who take the time to understand them. That feels unfair. Maybe it is unfair. But knowing the rules doesn't require a finance degree. It just requires a willingness to sit down, look at the numbers, and ask a few calm questions before making decisions that last the rest of your life. The best time to learn this was 20 years ago. The second best time is today. You're already doing it by being here. Take care of yourself. Take care of your savings. And remember, working hard got you here. Working smart is what keeps you here.